Welcome to another podcast of the Riffle series, the Riffle podcast series brought to you by 10 Leaves.
Thanks for having me back.
Yeah, it is. It's great to have you here because today we are going right behind the curtain of global finance.
We really are.
We are taking a deep dive into a rare, highly detailed regulatory playbook. We want to see exactly how major financial regulators manage severe geopolitical stress.
Right. And our mission for you today is to decode this deeply fascinating document. We are going to uncover the exact early warning indicators that these regulators look for.
The red flags.
Exactly. The red flags they use to prevent a market panic before it, ever really has the chance to start. We are looking at the raw mechanics of systemic preservation.
And the source we're analyzing today, it's incredibly specific.
It is.
We've got our hands on a Dear SEO letter.
And just to clarify for everyone, SEO stands for Senior Executive Officer in this context.
Right. Directed straight at the top executives.
Yep.
And this was sent by the Dubai Financial Services Authority, the DFSA. And the date on this is March 1st, 2026. The subject line is just regional uncertainties.
It's very direct.
It comes straight from Justin Baldacchino.
The Managing Director of Supervision.
Exactly. Located at level 13, The Gate, P.O. Box 7feet850 in Dubai.
When a regulator operating out of a major global hub like the Dubai International Financial Center, the DIFC, sends a direct communication like this.
Right, to the top executives of authorized firms.
Yeah, they are laying out a highly engineered framework for survival and stability. This isn't a routine update newsletter.
No, definitely not.
It is a mandate for hypervigilance during a really volatile period.
And the tone of this letter really stands out right from the very first paragraph.
Yeah.
It has this fascinating dual purpose.
How do you mean?
Well, on one hand, the DFSA is clearly acknowledging this rapidly evolving, uncertain situation in the Middle East. They aren't, hiding from the reality of the geopolitical environment.
Right.
But on the other hand, the text is decisively asserting control. It's calm, sure, but the expectations they lay out are incredibly rigid.
What's fascinating here is the heavy reliance on systemic resilience.
Yeah, they bring that up early on.
They do. They specifically reference the financial system's post-COVID strength. The letter explicitly states that financial institutions incorporated in the DIFC, especially the banks, they're operating with really strong financial positions.
Right.
They note that these firms are maintaining capital and liquidity buffers that are well above the minimum regulatory requirements.
Yeah, the letter specifically points to those post-COVID capital buffers. But, in a massive regional stress event, are those buffers actually enough to stop a panic?
Mm-hmm.
Or is the regulator just, pointing to past data to project confidence?
Well, the regulator backs up that assertion with specific data from a recent stress test.
Okay.
The text points out that this internal testing showed DIFC banking subsidiaries would actually be resilient to a prolonged economic stressed period.
A prolonged period.
Exactly. They are setting a psychological baseline for these firms by reminding these senior executives that the system was literally engineered to handle severe stress. The regulator is essentially removing any excuse for institutional panic.
Oh, I see.
The buffers are specifically designed to be drawn down to support the real economy, and absorb potential losses during moments exactly like this.
That makes sense. And the DFSA also spends time in this letter reassuring the market about its own operational continuity.
Right, their own internal house.
Yeah, they explicitly announced that their regulatory and supervisory functions will continue largely as normal. And they say that's supported by their ongoing investments in digitalization and RegDetect.
Regulatory technology.
Right. It feels like the regulators essentially saying, our own house is entirely in order, our oversight won't be disrupted, so your operations cannot afford to be disrupted either.
That's spot on. By guaranteeing their own operational resilience through those digital investments, they set an uncompromising standard for the authorized firms.
No excuses.
Exactly. It establishes a baseline where the regulator remains fully capable of monitoring the incredibly granular indicators they're about to demand from the market.
Okay, let's unpack this. Because the letter doesn't just offer reassurances and set expectations. It comes with a highly detailed attachment called Appendix A.
Yes.
And this is where the true playbook is revealed.
Yeah.
The DFSA provides this non-exhaustive list of enhanced indicators that these firms are expected to monitor incredibly closely.
This is the operational core of the entire document. These are the cross-cutting warning signs. And it starts directly with governance and decision-making.
Right.
The regulator requires firms to monitor for a material divergence between local management and the group or parent entity's risk appetite or strategy.
Think about the operational friction that implies. Imagine you are running a local branch in Dubai, and you're seeing regional developments up close, right?
You're right there on the ground.
Exactly.
Yeah.
So your risk appetite is shifting rapidly by the hour, but your parent company, sitting in another hemisphere, is operating on a completely different strategic timeline.
Yes.
The DFSA is identifying that exact corporate disconnect as a major early warning indicator of instability.
Because that divergence creates a dangerous lag in crisis response. If you have to wait for a parent company that doesn't grasp the immediate local stress, you lose crucial reaction time.
Wow. Yeah.
The regulator also highlights constraints on effective oversight due to absenteeism, travel restrictions, or limitations caused by remote working.
Really? They mentioned remote working.
They do. If the personnel required to make critical split-second financial decisions aren't physically present or fully integrated due to remote constraints, the regulatory framework views that as a systemic vulnerability.
That is fascinating. The appendix then shifts into operational resilience and third-party dependencies, and the level of specificity here is just stunning to me.
It is very detailed.
They specifically call out the disruption or increased fragility of critical outsourced services. They list IT, payments, settlement, treasury, compliance, and risk management.
You have to look at how that connects directly to the section on cyber and technology risk. When a firm relies on fragile third-party networks, or if they have to fall back on alternative emergency arrangements, the surface area for cyber threats naturally expands.
Because the normal defenses might be down or bypassed.
Exactly. The text explicitly demands monitoring for an increase in cyber threat activity. They specifically call out ransomware, data exfiltration attempts, and phishing.
The explicit mention of data exfiltration attempts shows they are watching for bad actors leveraging regional distraction to compromise sensitive information.
Yes.
But the text pushes that even further by highlighting delays or failures in incident detection, escalation, or response arrangements.
That's a huge point.
Why is a delay in the internal incident response treated with the same level of severity as the actual cyber attack itself in this framework?
Because of the compounding nature of risk in a stressed environment. A delayed response to a cyber intrusion or even just a third-party IT outage doesn't just stay an IT problem, it instantly metastasizes.
Right.
If clients cannot access their accounts or execute trades because an incident wasn't escalated quickly enough, you trigger a catastrophic loss of market confidence, and that bleeds directly into liquidity constraints.
Which brings up the financial position indicators. The text requires firms to look at their internal stress testing and scenario analysis. It specifically asks them to reflect on forward-looking regional escalation scenarios.
They need to project the worst-case regional outcomes.
Yeah. And they also flag emerging constraints on upstreaming or downstreaming capital and liquidity within corporate groups.
Yes.
Why is moving money inside your own corporate family suddenly a red flag for the DFSA?
It signals that contagion is actively spreading across borders.
Okay.
If a local Dubai subsidiary is suddenly prohibited from downstreaming emergency capital to support its own local operations.
Or conversely, if it can't upstream cash back to a distressed parent entity.
Exactly. That means the internal liquidity corridors of that global institution have frozen. The regulator needs to know the exact moment those internal corporate arteries start to harden.
Which brings us to Section B of the appendix, capital and liquidity indicators. The DFSA wants to know about expected or emerging losses that could materially impact a firm's capital resources.
They are looking for the emergency levers that management might be forced to pull.
Like suspending dividends.
Suspending dividends or requiring emergency capital injections just to maintain basic capital adequacy.
Those actions are basically the loudest possible alarms that a firm is actively burning through those robust post-COVID buffers we talked about earlier.
Absolutely, but the liquidity indicators the DFSA lists are where the immediate existential threats to a firm really reside.
The text lists the non-renewal of deposits, early withdrawals, and large unexpected drawdowns linked specifically to regional confidence effects.
If we connect this to the bigger picture, liquidity is the oxygen of the financial ecosystem. The text doesn't just focus on retail deposits either.
No, it goes much deeper.
It highlights a significant reduction in the wholesale funding market and challenges or an inability to access interbank funding. It even goes as far as explicitly mentioning a freeze in repo markets alongside increased collateral posting requirements.
When a text like this explicitly points to a freeze in repo markets and severe interbank funding challenges, it means the DFSA is preparing for a scenario where institutional trust evaporates completely.
Yes.
If banks stop lending to each other overnight and wholesale funding costs experience a material increase, the systemic seizure is already underway.
And the regulator is demanding visibility the moment that institutional trust begins to fracture. They understand that a firm's capital position might look perfectly fine on paper.
But in reality,
In reality, if they face increased collateral haircuts and cannot access the repo market to fund their daily operations, insolvency can happen in a matter of days, if not hours.
here's where it gets really interesting because the DFSA doesn't stop at those broad, cross-cutting banking indicators.
No, they drill down.
Yeah. Section C of this appendix breaks down highly tailored warning signs across 5 specific business models. It is an incredibly granular playbook based on the precise mechanisms of how different sectors fail. Let's start with the first one, credit and lending activities.
For lenders, the early warning indicators naturally focus on asset quality linked to regional counterparties or sovereign exposure.
Right.
The DFSA is watching for a material increase in non-performing loans, delinquencies, and increased requests for restructurings, forbearance, or covenant breaches.
They also specifically flag severe stress in the valuation of the collateral backing those loans. But that kind of stress on collateral valuation doesn't just sit quietly on a commercial lender's balance sheet, right?
Definitely not.
So how does the DFSA expect that asset deterioration to bleed into the next business model they list, which is capital markets and trading activities?
Well, collateral stress in lending instantly translates to volatility in the capital markets. For trading firms, the DFSA is targeting elevated market volatility leading to significant mark-to-market losses. When asset values swing violently, the regulators expect firms to report immediate increases in margin calls, massive collateral haircuts, and severe counterparty disputes.
The text even calls out disruptions to execution venues, clearing, settlement, or custody arrangements.
The actual plumbing of the market.
Right. If the plumbing of the trading market gets clogged due to a dispute over a collateral haircut, the regulator needs instant visibility before it triggers a cascading failure.
The speed of contagion in capital markets is exactly why the reporting threshold is so sensitive. A settlement failure on a volatile trading day can instantly compromise the liquidity position of multiple interconnected counterparties.
So if the trading floors are dealing with margin calls and settlement disruptions, the third sector, asset management activities, has its own set of critical triggers in this appendix.
Yes, and these are very specific.
The DFSA asks asset managers to monitor for accelerated or disorderly redemptions, as well as valuation uncertainty, gating considerations, and side-pocketing decisions. Could you explain those terms?
Those terms represent the absolute extremes of asset management stress. A disorderly redemption scenario creates a brutal liquidity mismatch.
Because everyone wants their money out at the same time.
Exactly. If a firm is forced to even consider gating, which means temporarily barring investors from withdrawing their capital, or side pocketing, which is moving highly illiquid, toxic assets away from the main fund, it indicates immense critical stress.
Wow.
The DFSA is demanding to know the moment an asset manager even entertains these mechanisms, because implementing them can trigger widespread market panic and contagion to other funds.
Moving to the fourth sector, brokerage and client-facing activities. For brokers, the indicators include elevated margin breaches, forced liquidations, and client losses.
But they also put a major focus on the retail and client level here.
Yeah, watching for increased client complaints or disputes linked to market stress.
The DFSA pairs those client disputes directly with technology or connectivity failures affecting order execution or client reporting.
This circles back to our earlier discussion on compounding risk, doesn't it?
It does. Think about it. If a broker suffers a fragile third-party IT outage during a period of intense regional volatility, and clients are suddenly locked out of executing trades or responding to margin calls,
then the resulting forced liquidations and client losses elevate a simple tech glitch into a severe regulatory and systemic crisis.
Exactly.
Finally, we have the fifth sector, insurance and reinsurance-related activities. The text warns of unexpected increases in claims frequency or severity directly related to regional events. It also flags sudden coverage disputes, exclusions, or uncertainty in reserve adequacy.
The inclusion of reinsurer credit quality is perhaps the most critical indicator in this specific section,
Why is that?
because reinsurance provides the ultimate safety net for the insurance sector. The DFSA text explicitly requires monitoring for the deterioration of that reinsurer credit quality.
Because if the safety net fails,
Right. If the entities backing the insurers begin to face their own capital constraints or rating downgrades due to regional stress, the foundational model of risk transfer basically begins to collapse.
so what does this all mean? We have this incredible list of interconnected indicators across governance, cybersecurity, wholesale liquidity, and 5 distinct business models. What are these senior executive officers actually supposed to do with this massive monitoring framework?
That is addressed in the letter's strict instructions on regulatory engagement.
Yep.
The mandate is absolute. Any material change, deterioration, or even a credible forward-looking risk in these specific indicators must be notified to the DFSA promptly.
Promptly.
And the crucial phrase in the text is that this notification must happen even where no regulatory breach has occurred.
That fundamentally changes the relationship between the firm and the regulator. You don't wait until you've actually violated a capital minimum or breached a liquidity coverage ratio.
No, you can't wait.
You're required to report the forward-looking threat of it happening, based entirely on the deterioration of these granular indicators.
The DFSA expects proactive, forward-looking communication rather than reactive damage control. Furthermore, the text dictates that when a firm does send a notification, it has to include management's comprehensive assessment of the situation.
They can't just drop the problem on the regulator's desk.
Exactly. They have to include the specific mitigating actions they are actively taking and their anticipated next steps. The regulator expects the firm to already have a solution in motion the moment they make contact.
But the text outlines a final, even more severe level of communication. Section D at the very bottom of the appendix outlines escalation expectations.
This is the red button.
Right. Here, the regulatory language aggressively shifts from notifying the DFSA promptly to notifying them without delay. What are the specific triggers that push a firm from standard prompt reporting into this immediate escalation protocol?
The text outlines 3 specific scenarios for immediate escalation. The first is when multiple indicators across Appendix A deteriorate simultaneously. This captures the essence of compounding risk we talked about. It's one thing to report a minor third-party IT glitch.
Sure.
But it requires immediate escalation if that IT glitch happens on the same day the firm faces a sudden wave of early deposit withdrawals and a spike in regional non-performing loans.
Because the compounding effect overwhelms normal mitigation strategies.
Exactly.
What is the second scenario for immediate escalation?
The second scenario is triggered when management judges that risks may become nonlinear or systemic.
Nonlinear meaning the damage is no longer scaling predictably. It is accelerating exponentially and poses a direct contagion threat to the wider DIFC ecosystem or the broader market.
Yes. And the third scenario requiring notification without delay is if confidence in the firm's ability to continue operations in an orderly manner is materially challenged.
Ultimately, the entire framework hinges on that word, confidence.
It really does.
Whether it's a repo market freeze, a consideration of fund gating, or a delayed response to a data exfiltration attempt, the moment a firm's management loses confidence in their own orderly operations, the DFSA demands to be immediately involved.
In severe geopolitical stress environments, the evaporation of operational confidence is the final early warning indicator before systemic failure. The DFSA's framework is designed to ensure the regulator is inside the decision-making loop, long before that final threshold is ever crossed.
This deep dive really changes how you view financial stability. It is clearly not a passive state that regulators just hope to maintain. Reading this March 2026 letter from the DFSA proves that stability is painstakingly engineered.
Down to the smallest detail.
It requires hypervigilance, continuous investment in operational continuity, a mandated open line of communication between regulators and executives, and an incredibly granular understanding of how a localized stress event compounds across different financial sectors.
This raises an important question, one that extends far beyond the Dubai International Financial Center. We've just analyzed the exact compounding early warning indicators that financial regulators use to predict and prevent systemic failure. It makes you wonder, if you were to draft an Appendix A for your own industry or even your own personal financial life, what would those hidden early warning indicators be, and how quickly would they compound in a crisis?
Identifying your own forward-looking risks before the alarms start ringing. That is a great thought to leave on. Thank you for joining us on this deep dive into the architecture of financial resilience. We will catch you on the next one.